Welcome to the Sage Planning Solutions Podcast. Join Brad Marshall, Patrick Bennett, and Dominic Ruiz as we help you navigate life's financial obstacles and find financial freedom.
Securities and advisory services offered through Cataray Grant & Company Incorporated, a registered investment advisor and member FINRA SIPC. Cataray Grant and Sage Planning Solutions are separate and unaffiliated entities. The information provided here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. Any opinions or forecasts contained herein reflect the subjective judgments and assumptions of the authors only and do not necessarily reflect the views of Cataray Grant & Company Incorporated. Investing is subject to risks including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. This information is not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Neither Cataray Grant & Company Incorporated nor its registered representatives or employees provide tax or legal services. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice.
Michael, thank you for joining us today. Just for the audience, Michael Guyed is the host of the Lead Lag Report, also portfolio manager for the JoJo RoRo ETFs, and also a mutual fund manager. So we're going to get right into it today. Michael, you are one of the first people, I think maybe you were the first person that was pounding the table for a long time about the reverse carry trade. We'll touch base on that. We'll touch base on the cost of oil, government bonds, how all this stuff is going to affect the equity markets.
All the softball questions. I like it.
We're not here for the gentle. We're not here for the gentle questions.
Cheers for that.
If you could break it down for if you're talking to a third grader, for example, and again, what are the implications of all this, and how did it start?
Yeah, no, and I appreciate the invite, guys. It's a very, very simple concept, which is money is global. You don't have to borrow in your local country. You can go anywhere in the world, borrow money in that country's currency, and then deploy that capital anywhere else in the world and hopefully make some bigger money. So why would you borrow from the US at our rates when you can simply borrow from a country like Japan, where their rates are effectively still close to zero, despite having raised rates? The carry trade is basically this idea that a lot of institutional players and maybe non-institutional players have effectively used Japan as their bank to borrow from at very cheap rates and then deploy that all around the world. So it's been a source of leverage. Now, you as the borrower of that capital from Japan, you're borrowing it in yen because that's their currency, which means that you like when the yen weakens after you borrow that capital, because it means from a currency conversion perspective, you actually end up paying back that set loan with cheaper currency, right? So it actually is beneficial towards your return. The opposite holds true, obviously, if the yen goes higher from when you borrowed that money. Suddenly now that fixed liability, because of the currency conversion, becomes more expensive to pay off. So imagine what happens when the yen keeps on weakening, as we had seen up until July. A lot of people borrowed from Japan and benefited from that currency conversion. Yen strengthens. Suddenly the borrowers get nervous that now they have to pay more adjusting for the currency conversion. What do they start to do? They sell off wherever they deployed that leverage capital from and start paying back that loan in Japan. And if everybody does that all at once, that creates a bit of a global margin call, which I think you saw the whites of the eyes of. Now, why does that matter in the context of what happens next? I have argued since August that the reason why you could have a spark, right, with Japan is that is really the price of oil, right? So Japan as a country imports pretty much all of its oil. Oil is denominated in dollars. So in third grade talk, it's your crayon priced in yen. If it's priced in dollars, it becomes a problem, right? In terms of you're importing crayons. But the more that oil stays where it is against a weaker yen or appreciates relative to a weaker yen, the more oil priced in yen actually increases at a faster clip. So if you can't control the price of oil, you can control your currency. The Bank of Japan steps in. That sparks a rally in the yen and sparks a reversal of that carry trade, which I still think is not over.
What does it look like when this starts to unwind? How does that going to affect the equity market? We got a glimpse of it on August 5th.
Yeah.
I was going to say, does it look like August 5th?
Possibly. I mean, I think that was so sudden and sharp that it felt like a panic global margin call type of moment. Market obviously totally forgot about it afterwards. Once everybody became an expert in the carry trade, right? It's exactly what happens. Everyone got so bearish and then the markets rips right back. It could play out in a similar way. I think it gets to be, I can make an argument it could actually end up being quite a bit worse. Not because I'm trying to be a fear monger, but you also now have the reality that the economy seems to be slowing to the point where we could be at the doorstep of recession. So you've got a combination of what could be a structural margin call sequel to what happened August 5th, combined with, in general, economic malaise and more volatility just from the domestic side, that could possibly metastasize into something larger. But it doesn't have to necessarily be a crash. It can just mean that you're going to have increased volatility for several weeks as a lot of this unwind takes place.
Everybody started coming out after you did and taking your version, still in your intellectual capital, posting their own videos, posting their own tweets about that. It literally almost word for word.
It was comical.
Yeah, I know. It just came literally out of nowhere, as if they're the ones that started this. But you've been on it before August. Moving on to interest rates and government bonds. Government bonds were in a bull market for 35, 40 years. Now that rates are starting to front run the Fed, are we going to be in a very similar, in your opinion, bull market? Maybe not as long, but is it going to have those equity-like returns for a very long time?
So if I've been right about anything about the reverse carry trade, it's that it would bring back the flight to safety in government bonds, right? So on X at Lead Lag Report, I've continuously put out, in a very obnoxious, annoying way, a emoji of the Japan flag with the Phoenix emoji, which Phoenix is the flight to safety trade in my parlance, and then the Doctor Strange from Avengers, one holding up his finger, one outcome type of thing. And ever since the reverse carry trade, you've now seen clearly, right, that when the markets are down hard, treasuries rally in price, long duration yields fall. Now, we've been in a duration bear market, right, the last several years as treasuries have gotten crushed from the fastest rate hike cycle in history on the long end of the curve. The question now becomes, could we actually be in the middle of, or at the start of a broader bull market for treasuries, where it's not just about the flight to safety trade, but because of the economic slowdown, because of rising unemployment, anyway, money goes into the quote unquote safety of U.S. government debt. Now, I get it. A lot of people don't like that idea because they see the insane spending that the U.S. government has been doing and continues to do. I don't care if you're a Trump supporter. I don't care if you're a Kamala supporter. I don't care if you're an alien that came from outer space and somehow ends up finding his way into the presidential election. Every president does the same thing. They all spend, which means the debt's going to keep going up. Supply is going to keep rising. So how could it be that government treasuries could be in a bull market if you're going to keep on supplying with more treasuries? The answer is very simple. If you have a recession, investors will do what they always do. They'll sell risk-on assets and they'll buy government debt until that recession is over. So I think it seems to be possible to me that we could be in a treasury, the start of a treasury run higher in price, lower in yield. And the Fed is then ultimately going to follow that. That does not mean that I'm bullish on bonds. The reality is on the corporate credit side, default risks are not anywhere near priced to what is happening in the real economy when you look at delinquency rates.
Do you think that equity markets and fixed income markets could be headed for something that maybe another black swan event? Corrections are sharper, recoveries are sharper. Just like we've seen on August 5th with the situation with Japan, it was quick. It was an intraday reversal. By the end of the week, we're either flat to slightly positive. Black swan events are also happening a lot quicker as well. If you look at 2018, when the Fed said, hey, we're going to cut rates, the fourth quarter, the market dropped 20%. Yeah, then you have COVID, and then 35, 40 days later, the market's flat to that entire black swan event. So do you think that we can have another black swan event in such a short period of time, considering the fact that we're going to keep spending? I think Rick Santelli was on CNBC yesterday just blowing off the lid about no matter what, government's going to continue to spend, no matter if there's tariffs or not, prices are still going to continue to increase. What's the outlook in your opinion?
Yeah, look, I think as a general rule, the more leverage you have in the system, the more fragile it is. And the more fragile a system is, the more likelihood that the time with which it breaks gets shorter. Right? So with every round of stimulus, you're increasing the debt. With every round of increased debt, you're increasing the fragility. Every round of increased fragility shortens the span between extremes. I think that's largely borne out historically. Now, as you know, the whole black swan term, the reason it's a term is because nobody knows what the actual black swan could be, right? I wouldn't actually view the reverse carry trade as a black swan. That's because to me, it's very obvious that that's sort of a dynamic there. Maybe something more akin to something really nasty coming from China would be more equivalent to a black swan, right? And that's, as we all know, been in a horrific kind of deflationary, almost depression type of cycle. Maybe it could just be some other dynamic when it comes from the geopolitical front. Speaking about China, for all we know, China could still end up going into Taiwan, fairly soon, and that would create all kinds of issues. Maybe the black swan is somehow it's these NVIDIA GPUs overheat, and there's some problem, and that creates a recall, and that creates all kinds of problems for NVIDIA. And NVIDIA has been such a big driver of the market's momentum. We're in a world where any number of things, large or small, can cause these air pockets. That's not to say you don't invest. It's not to say that you short. It's just to say be mindful of the risks.
I've been sort of impressed with the continuing and high level of functionality in markets when there are big sort of moments of intraday chaos. And I guess putting that aside, when there was the big margin call in 2009, we were a great beneficiary of that because we were able to buy things at pennies on the dollar for our clients, and it was a great deal for us. To be honest, it was rough, it was hard, but that was a certain level of leverage, and to me, that's the mother's milk of every great meltdown where everybody sort of slaps themselves in the head. And you touched on it here just a moment ago. Can you give me an understanding? Where are we in terms of leverage now compared to where we were 15 years ago?
Probably orders of magnitude higher than people realize. And a lot of people already say there's a lot of leverage. And the reason I say that is because never in history have you had so many derivatives on derivatives, options on options, leverage on leverage, where you can do call options, which are basically levered plays on levered funds. I don't know if people really appreciate or understand just how little actual collateral there is relative to how much margin there is, which, by the way, again, would argue for a flight to safety in treasuries. Despite all
so that's the story behind the story, is when you're stringing out 3 and 4 and 5 investments all based on one. It's when I remember I'm on a conference call and they were talking about how they were shorting the credit default swap on the German Bund so they could make 0.007 basis points, and they're running this trade every day out for 6 months. And, the return on the investment was minuscule. However, they were doing it. But if something in the middle of that trade unravels, it blows up. And Dominic talks about there's 3 ways that you make money in this world, right? When it comes to investing, it's either you invent something, you steal something, or you are working with information that the rest of the street doesn't have. Yeah. And when those 3 aren't available, you end up getting these strange hybridized investments that, let's face it, even if the creators could truly explain it, who's going to frickin' understand it? And it's one of those things where the details are usually so embarrassing that the truth will never be known. And so if you're saying that our leverage now is orders of magnitude higher than it was in 2009, there's almost no protective trade. Would you agree with that? Or is that too broadly spoken?
Well, no, I go back. I mean, there will be certain things that would be relatively close to protected, right? I go back to treasuries for a moment in time, golds, right? Maybe even Bitcoin, depending on how things play out. How many of you are use DraftKings, like bet on DraftKings, the app? None?
No.
Good for you, because I'm blown away by how many people are betting on DraftKings. And I'll tell you why I'm saying that, which goes back to this point about leverage on leverage. It's a bigger conversation, I think. We're at a point now in society in general where everyone is just basically betting. And if you're betting, you're leveraging. Pure and simple. Doesn't have to necessarily be about stocks. You can see it from what people are doing on their phones. And it's been allowed, and you can argue it should be allowed, but it also, again, creates a degree of fragility, right? Because, hey, you can always just put more capital into that DraftKings account. You can borrow and bet that on the next parlay or whatever it is that people are betting on.
Is it that big of a deal? Really? People are using DraftKings that often?
Well, what I'm saying is it's more emblematic of the mentality, right? Yeah, DraftKings has been unbelievable in terms of how many people. Just ask, now that I've said it, ask anybody that you know, ask your clients, ask your friends, ask somebody randomly on the street.
It's too bad. We've had a few instances over the last couple of decades where there's been such a washout. And instead of having a renaissance, I think we were bailed out. We were bailed out in 2010. We were bailed out, 2020, 2021. And it's funny, I was listening to something the other day and it was talking about returns in private equity. And the biggest cost of private equity, in one sense only, is all the dudes that need to get paid off for all these things to be able to make money, because there's just levels and levels and levels of people who, have a hook into deals that are sold away to bigger and sold away to bigger. And this marketplace, it's like you have 1,000 people all betting on the same dollar. This marketplace is so crowded. You'll hear certain people talk about return to this and return to that. I don't think there is going to be a return to anything that looks like the new normals are constantly changing. And when you talk about derivatives on derivatives, you're talking about a world that I would say 99.9% of everybody that's an investor has no idea that actually even exists. And the head scratcher that was long-term capital management, that was almost kind of like a primer. Like that was sort of like a kindergarten example of what it is that you're talking about now.
Most people have no idea who's running the country, okay? Let alone that any of this stuff exists. I mean, again, I go back to it's a bigger discussion. I keep emphasizing this point. The average reading comprehension in the United States is 6th grade level. Most people have no clue about anything. They're just distracted constantly.
Yeah, the other problems with private equity, again, talking about debt, they're highly levered. The J-curve effect, as you said, Pat, the high fees, the illiquidity, concentration, some of those fees. I mean, you got the 2 and 20, and then you got the time that you have to stay in. I mean, 7 to 10 years, and then and usually they're extending that right now with these higher interest rate environments and all the economic risks that come with that. Probably not the best place at the moment.
No, and I'll take it a step further. It's easiest to leverage something which is not mark to market, right? Because if it's not mark to market, you don't know what the actual collateral is. You just use some stale price, and that stale price is probably inflated. So let's take it from not just a discussion around private equity, but then private credit, where all this money has gone in and chased, right? And I'm sure there's a lot of credit that's solid and strong. I'm also sure there's a lot of private credit, which is probably very ugly in terms of the default risk, but it's not being priced properly. And because they got high yields, hey, let's lever that even more. And it works until it doesn't. Right? It's like everything else. The moment you mark to market anything, suddenly it becomes questionable what your assumptions were to begin with.
Yeah, all the data is like real estate, right? Yeah, all the data is smoothed.
Right, and it's smoothed by those who have an incentive to smooth it because they're paid on that.
I know that Brad always has a very important question, and that's the de-dollarization and the BRIC countries and currencies that they're trying to establish. Brad, why don't you ask Michael what his opinion is on that? Because I know you have a different way of asking.
So what's the solution? We know anybody who understands what's happening knows that we're on the decline. So what's the solution? What are we going to do? De-dollarization, that oil is and the BRICS countries are getting away from the US dollar. And we've had other people on the podcast that say, look, the US dollar is still the best of the worst. And because we all have dollars. What do we do? Theoretically, assets could rise, real estate, gold, whatever. Assets could rise while inflation continues, while we keep printing money, etc. Like, what's the solution? What do we do? What do we do? I'm being serious, man. What do we do about this? I hear you, Michael. Like, I follow you. You're comfortable being politically incorrect, and I dig that about you, man. What's the solution? Come on, man.
So a couple things. First of all, I clearly there is a trend, but it's a slow trend of de-dollarization. I think that's important because the reality is, why is the dollar the reserve currency? Because we got military bases everywhere. Let's not forget that we spend an exorbitant amount on defense spending, have our military troops all over the world, and when you have guns, you have a funny way of getting people to use your currency for transactions, right? So I think I don't see that changing anytime soon. Now, having said that, the only way you stop the dollar from being as garbage of a currency as it is, being the cleanest dirty shirt in the room, whatever the expression is you probably need to stop democracy. Okay, and I say that very purposely because why is the dollar not what it used to be? Because of government debt. How do you get elected? Government debt. You got to promise more stuff. I mean, that's kind of the irony of all this stuff. Everyone talks about democracy, free speech, and yet the people don't want to vote for the person that's going to say, you know what we need to do is we need to tighten the belt. No, they're going to vote for whoever's going to spend more and spend for them. So of course the dollar is going to be trashed. We're causing it. We're the reason. So, unless you believe that suddenly the 6th grade reading comprehension goes to 12th grade, okay, or even college level, and people start saying, you know what, this can't last forever. We actually have to go through some austerity. That is the only answer.
Well,
I don't know how any other way.
Funny you mentioned that, because Rick Santelli yesterday, who I find very entertaining, he said the same exact thing. People, if you really want to know what's going on, read.
Yeah.
Literally, he said that, and he was so upset about it, just because.
Yeah, it's like the powers that be always have an incentive to make everybody else beneath them not pay attention. Right? It's just power stays in power by being unchecked. Okay, so how do you keep power unchecked? By distracting the populace with memes and social media and shows on Bravo, okay, and things like that. Not that I'm picking on Bravo. Well, maybe I am a little bit. I'm just saying, like, reality things, right? It's like, it's the whole bread and circuses thing.
Just a continuation of dumbing down society.
Yeah, and also the fake outrage machine, right, which gets people riled up over things that are at the end of the day meaningless. For all the talk of all these federal policies and things that Harris might do or that Trump might do, and people getting all riled up, and all these pundits and discussions around what's right and what's wrong, all these people who get outraged, they have no idea about their own local elections, where the things they are complaining about or worried about as far as who's going to be president and what they're going to do, it's the local elections that actually affect that in terms of them personally, not the federal. But hey, we're distracted by the traditional media that wants to focus on that.
Raising my hand as the conspiracy theorist in the group. Michael, why aren't you afraid of saying the things you're saying? These are the things that everybody needs to know, but you're one of the few people saying it. Why and how? I got to know.
Look, I mean, for me, it's I've got a certain style of communication on X in particular, which gets the algorithm riled up. I know how to play that game. I also just in general believe that you can't live life not expressing your truth to some extent. I think people need to take a step back and go back to core principles and logic. And I find that I think a lot of logic is missing in today's environment. Everyone just is reacting and no one's actively thinking. And listen, even in this business, right? I mean, talk about active thinking from an investment perspective. If you have any knowledge of markets at all, you know that markets go through cycles. To the extent that clients compare your portfolio performance against the S&P 500, and they say, well, why not just be all in the S&P 500? And that's like an 80-year-old grandmother. Logic would say that's a ridiculous argument. And logic would say that at some point the era of large cap dominance ends. But nobody ever invests based on logic. They react, just like what's happening in, what you see on news media. So I don't know if it's just a function of sort of I'm like saying anything that's unique. I have a natural skepticism against the nonsense.
Dominic, post that. Would you say I have a natural skepticism against cut and paste that in everything?
Cut and paste that. Just re-edit that. Exactly.
Well said, man. Well said.
I always find it entertaining when people try to compare you against the S&P 500, and it's typically during bull markets.
It's stupid.
It's weird.
Stupid. No, and I'm sorry, I'm going to say it all right. It's stupid. Now with the kind of concentration risk that's in the top 3, 4, 5 names. Okay, I get it. It's worked. Talk about everybody being on the same side of the boat, holding an anvil. It's not just U.S. investors in the S&P 500. It's the Japanese investors doing the carry trade that are in the S&P 500, which means they're largely in 3 or 4 stocks. And again, I get it. It's worked. What happens when it doesn't work?
It's funny. There's like 2 sides to the same coin. It's that old phrase, don't fight the tape, meaning if it's going, go, follow it, jump in. Don't try to be smarter. Don't try to be cool about it. Don't try to pound the table on your cool argument of how, like, I'm very much picking up what you're laying down. It's more just like, hey, just do what everybody else is doing. It's easier to complain and it's easier to be ignorant and then just complain when things don't work out your way. I mean, that's just human nature. That's just lazy people being lazy.
Yeah, it's easy to complain and it's easy to comply. There have been passive investing. There's a time for it. There's a time when it's better to be active. Cycles. There's a time for it's like everything, the old Ecclesiastes thing, right? There's a time to grow, a time to die, a time to whatever. Like passive has clearly worked. But the problem with, everybody looking at the S&P 500 and comparing against it and then saying, if you can't beat them, join them. It's like, all right, well then almost by definition, doesn't it mean you should not be in the S&P 500? I mean, let's go back to the DraftKings, right? Everybody's making a bet on something happening.
Yeah.
All right, well, if you're making a bet on something happening, don't you split the pot against so many different people then? Isn't the payoff better where you go where nobody else is going or betting on, where the odds, might actually be better, than what the bookies are telling you? I don't know. I mean, I maybe that's just me being contrarian for the sake of being contrarian, but I fail to understand how we got to a point where anything outside of the S&P 500 should be untouched, avoided, and you suck if you do anything except that.
Well, that's what Pat Bennett lives. He loves dividend paying stocks. And well, I mean, and they're catching a big bid, right, Pat? I mean,
They should be.
right now they're crushing, and that's where people are still focused on Nvidia, where companies that are value stocks paying dividends that have been growing year on year with strong balance sheets, and nobody's paying attention to them because they're not sexy.
Yeah, I believe in balance sheets, not in stories. There's a lot of, people want to suck at the tit of stories, and they want to be part of a tribe, and they want to be part of a movement, and they want to be unique, and it's nonsense. It has nothing to do with investing. And it's, you said it earlier, we're in a DraftKings mentality. The these crowded trades, I mean, I don't care. Let's be honest. Dominic and I love it when there's an absolute effing washout in the markets, because it's just a big slap in the face to everybody, in just different degrees. For some people, it's a 1 out of 10. For most, it's a 7 or 8 or 9 out of a 10. And it just kind of like, hey, there is no free lunch out there. Like in 2008, when every third bozo you met on the street was a mortgage broker, and everybody and strippers and limo drivers all had 5 houses. That there is a problem, to the point of believing in balance sheets. Yeah, I still do believe. I still am that guy.
What I'm hearing from Michael, and you said yourself, like maybe it's a contrarian trade, but to Pat's point, to your point, it sounds like we're at a top and it's getting frothy, and like, what is going on? Like, what are we doing?
Well, look. Okay, so I think terminology that's thrown in there, like we're at a top and not at a top. Like, I know why people say that and why they frame it that way, but top in what? Like, let's. It's like the top for small caps still hasn't been overtaken with the Russell 2000 index going back to 2021. Small caps, which are the small business equivalent of the public markets, for the most part, have not been in a bull market. Certainly not after inflation. Microcaps, worse. In a bull market, the riskiest parts, which are illiquid, tend to have the best returns, which are the small, very far away from the 2021 peaks. It has been like this. It looks like a bit of a lost decade for most stocks beneath the surface from those 2021 respective levels. So the question of whether it's a top in quotes the market is really a question of, is it a top in the narrative around AI? Because I think that's the sort of the narrative around AI, and then of course the concentration that has resulted in, right? What I call the concentration bubble. We could be. Just the other day, Jensen comes out with a statement when the markets are down, and the market rips higher just based on his words. I mean, this you remember, you guys have been around for a while. You remember it was a well-documented phenomenon when Cramer was, at his kind of height of influence. They called it the Cramer effect. The moment he would mention some stock, that stock intraday would go up, 10%. Right? People would just follow the guy or whatever he says. Oh, his recommendations are unbelievable. We're at a point now where it's all in story. And your point about balance sheet is investing in companies. Stories are investing in the madness of the crowd, which can be profitable, but also very risky.
Yeah, we had a guest on. He was talking about one day we're going to wake up and Nvidia has a high chance of being down negative 30% in one session, and which is the start of the unwind.
I mean, if that happened, I will be very annoying on social media. There's no doubt about that from that standpoint. After being dead wrong about Nvidia's momentum, I mean, look, and in fairness, right? I mean, it's like clearly the demand is there. Clearly the fundamentals are strong, but not to the point of the valuation expansion that we've seen. I think we can all kind of agree on it. The bigger thing with Nvidia for me, and the AI story in general, it's more than just Nvidia. The human mind is notoriously bad at putting a time frame around something. It's like, I thought we were supposed to have flying cars by now from the Jetsons, right? It's like, we're not good at estimating. It's like very well known from a lot of behavioral psychology studies. Mm-hmm. So we're supposed to already have self-driving cars. Okay, we're getting closer to it. It could be another 10 years from now until it's really, really fully autonomous, right? So my point is that AI is clearly real, but is it going to be real on the time frame that investors are putting the valuations on? Because that's what's going to determine everything. And we actually don't know. It's like, all right, well, let's make a bull and bear case. Let's say you have a recession. On the one hand, you'd say, well, that should break the AI trade because recession means stocks go down. AI has been the big driver of the gains. Well, then again, maybe if you have recession, unemployment rises, and then companies start saying we need more AI, right? So even this narrative around NVIDIA and AI is complicated because you can make an argument for almost anything at this point. The one thing that I think makes the most sense, though, is leaders become laggards, laggards become leaders, which means at some point, if the AI trade is real, you should expect it to expand out beyond a select number of stocks, which is really an argument for those small caps that have not made 2021 highs to finally play catch up.
We know that just like the internet, it was a big craze to begin with. We really didn't see the impact of the internet until maybe 2003, 4, and 5. I see AI as something very similar. How long do you think we're going to see the benefits of using AI?
It's unclear because right now, what's AI being used for? Okay, so as far as consumer application, okay, generative art writings and people basically on the generative art side creating things which are more comedic or offensive than actually useful. This is what happens. It's like you give somebody a tool, they'll find a way to use the tool in ways that are not productive just to kind of mess around and explore their weirdest imaginations. Right now, it doesn't seem clear to me that any company has really generated some increased efficiency or revenue.
Dom was mentioning earlier something that we were talking to on this podcast, and he was saying at some point the CIOs are going to come in and say, guys, where's the money? How can we monetize on this? And when there's 5 companies that all of a sudden stop putting in orders for AI chips because we're trying to figure out, like you just mentioned it perfectly, at the margin, hey, you could take a picture and have your dog's head, whatever, like the nonsense. But at what point does it come in and become the tool? The interesting thing was, 97, 98, 99, nobody knew what the internet was. And anybody that had the handle .com at the end of their company was getting banked because no one quite knew what was coming out. And there was lots of buildings that had 100% capacity off of Great America Parkway in Santa Clara because everything was sort of following what's going on with the internet and how's it gonna happen. And I think I love the way that you reframed how people are not good at time, right? When Dominic and I talk to our clients, we'll say, let's think in terms of 4 years. We could do 4 years because high school, college, things like that. But in terms of the mysticism behind new technology and what it's supposed to do, yeah, it's one of those things that just people really can't handle. I mean, who's the founder of AOL? Co-founder, was it Scott Case?
Yes, Steve Case, right?
We're in MIT Stanford Venture Lab meeting, and everyone's crowded around the mic, and you have all these engineers raising their hands and asking questions about nanotechnology. And he basically says, guys, we're 20 years away from that. It's not going to happen. Medical devices maybe at some point, but someone's going to have to figure out how to make the tools, and you can't even see this stuff. Dominic and I have talked in the past about how we feel very, very fortunate because I wasn't so sure that I was going to get the second coming of the killer app in my work lifetime. I'm not saying AI is at this point. I'm not willing to plant my flag on that because right now, like you said, at the margin, it may be, it's kind of like the blockchain story, in a lot of ways, yes, it's helpful. It's going to be there. It's going to be a tool, but is it going to be a revolutionary tool? Yeah. Anyway, just really like the way that you put things into context. I appreciate the way that you're not pounding the table. So many of your, I don't want to pick on you, but it's like so many of your followers, you just kind of go, who are these bozos? Come on, guys. Do some thinking for yourself.
You answer your own question on that. And another example of that is 3D printers. I thought 3D printers were still off manufacturing. It's like, okay, whatever happened to that, right? So, but no, I joke about
the Medlock.
But look, I'm fortunate that I have nearly 1 million followers, and it's just a standard bell curve in terms of intelligence levels, right? And what they're listening and paying attention to. I think I've been fairly consistent in terms of the way I think about things, right? I'm trying to adapt on the conclusion, but the way I think about things, I think has been fairly consistent. A lot of people think I'm some perma bear. It's like, no, I'm not. It's just, this is a very weird cycle because again, most stocks have not participated. Going back to the reverse carrier trade, if that and time, everyone seems to think that in 2 trading days, a 2-decade-long phenomenon got unwound. That seems crazy. It takes longer than that. It goes back to that point. We are notoriously bad at estimating how long it takes for things to take place.
Well, that's also fear of missing out. We've talked about that a million times. Where people market, that was an opportunity. We didn't take advantage of it. It was fear of missing out. There'll be another one.
Yeah, there always is.
Look, the markets,
not all trees grow to the sky.
Look, the markets are inefficient. If we could just encapsulate what we're here to do is for Michael to tell us what day we should start selling.
You got to have me on for another show so I can tell you the exact day. Right. I'll tell you after it's too late.
I'm sorry, Michael. We're just looking for the day. No talk.
I know.
Just the day.
I said, you want to give me the easy questions. I said at the start, the softballs. I like it.
The pain behind the Michael Burry story, if you look at that and how much he had to walk through in order to stand behind that trade, it's one of, I have so much admiration for that guy, and he had to basically suffer in silence for years until the trade actually started unwinding and he started profiting because of it. And I guess if it tells us anything, is that the louder that people are yelling, the more they're pounding on the table, they've got nothing. They've got absolutely nothing. And the more silent people are being, and the more suffering they're doing in silence, the more they're standing by their conviction. Thank you so much for all your time here today.
Yeah, we appreciate you coming on.
Thanks, man.
Thank you. All right.
Appreciate your time.
Enjoy.
Amazing.
I'm sorry. What's the day?
Stay tuned. Stay tuned. On the next episode.
All right, brother.
Thank you, Michael.
Cheers.
We'll see you.
Thanks for listening to the Sage Planning Solutions podcast. Be sure to subscribe so you don't miss the next episode. If you want more information, visit our website at sageplanningsolutions.com.